Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and this is my weekly stock market update for the week ending Friday, March 22nd, 2019. Before I jump into my charts and commentary, I'll quickly begin with the quote of the week, and this is from one of my favorite authors, Arthur C. Clarke. He once said, "The only way to discover the limits of the possible is to go beyond them into the impossible." Those are some wise words from Arthur C. Clarke. Anyway, what I'm going to talk to you about today are four things. Number one, I'm going to revisit stock market valuations of the S&P 500, which are at record highs. They are at 90-year highs. Going back to 1928, the S&P 500 has never been more overvalued than it is right now and last October. So we came off the top there for 3 months at the end of 2018, but we're right back up there in the stratosphere when it comes to valuations. So I'll cover that. Number two, I want to talk about the retest of the 10-year trend line for the S&P 500. Number three, we're going to talk a little bit about corporate buybacks, which are a big driver of this post-Christmas stock market rally and last year's stock market as well. And then a quick description of the relationship between the S&P 500 and the Value Line Geometric Composite, which is a much broader stock index and a much better pulse of the U.S. stock market and the U.S. economy. But before I do, I'd like to ask you to please subscribe to this YouTube channel if you are able to do that on the platform that you're watching this on. If you're on social media, then like or follow the page while you are there, but if you are on YouTube, subscribe by clicking that subscribe button and then click the little bell next to it so you'll be notified whenever additional videos are posted. Well, with that said, let's go ahead and jump into one of my favorite charts from John Hussman showing the current valuation of the S&P 500. This is a chart of the price to earnings ratio as created by John Hussman. There is another PE ratio called the cyclically adjusted price to earnings ratio, or CAPE ratio. The CAPE ratio is created by Robert Shiller, and it is commonly used in the financial world to give people a picture of the current valuation of price of stocks relative to corporate earnings. John Hussman took Robert Shiller's cyclically adjusted PE and adjusted it for profit margin, because profit margin is something that you typically can't manipulate with stock buybacks. And so John Hussman discovered that this particular chart and this ratio called margin adjusted PE is more accurate than Robert Shiller's CAPE ratio, and that's why I use this one. You can see on this chart, way over here on the left-hand side, right there, well, that is the 1928 stock market valuation peak. And we dropped and we were down here in the basement. It dropped from 44 all the way down to about 5 by 1942. And then we had the next real high here in the year 2000. And we dropped from over 40 back down to below 20 in 2002 and 3. But what I'm getting at is, look where we are today, right here. As of March 1st, 2019, we are up here at the highest level that we have ever been since 1928. And we fell down to about here. We went from about 45 or 46 last September down to about 37 or so, but now we're all the way back up to about 43. So we are at elevated levels of valuation, and the best time to buy stocks is at these troughs down here, like 2009 and 1983 and 2003, those kind of things. And the best time to be cautious is when you're up here above 40, like in 1928, 2000, and today. Okay, so I told you that the stock market has also been in an uptrend for about the last 10 years, and I covered that in last week's video. The trend line from the lows of March 2009 to 2016 and drawn all the way up to 2018 was broken in October. and we still are below that line. Let me go ahead and bring that chart up so you can see it. This is an 11-year chart of the S&P 500, and like I said, if you draw a line from the low down here, 2009, you draw it up to the low here in early 2016, which was February 2016 right there, and you project that on forward, you can see that we broke this big red candle here in December. We broke it with some serious conviction, lots of trading volume, and we have since rallied back up to touch that line. And we are sitting right on it for 4 weeks in a row. Let me change the chart just to show you the last 12 months, and it'll be a lot easier to see. This is the 1-year chart, and these are weekly increments. Each one of these little candles is a high, low, open, and closing price of the S&P 500 for that week. And you can see that we broke that trend line going back to 2009 in October, rallied back up above it for 2 weeks, failed again in November, rallied back up again for 1 more week, and then in December the hammer came down and it dropped about 10 or 15%. So we fell all the way down here, and since Christmas, all we have done is we have rallied up to retest that trend line from 2009, and we haven't been able to get above it. And that is concerning because that 10-year trend was support all the way up until October, and then that support was broken. So that 10-year trend line is now acting as resistance. And you can see that 4 weeks ago, right here, we popped up above it, but closed back below it by the end of the week. And then 3 weeks ago, we dropped 2 to 2.5% or so in the U.S. market. And then last week, we rallied back up and touched it, but closed back below it. And this week, we popped above it on Tuesday and closed back below it by Wednesday afternoon. So far, as of the recording of this video, for 4 weeks, this 10-year trend line has held as resistance, and if it continues to hold and the market starts to capitulate and roll over to the downside, we could easily see a 5% or 10% or even 15% decline back to those Christmas lows, depending on how bearish or weak this stock market is. Okay, the third thing we're going to talk about is those corporate buybacks I was telling you about, and that was corporations are buying back their own stock with money from their own treasury, and some are even borrowing money to buy back their own stock. They did that over the last few years, in fact. They figured it was better to go into debt to buy back stock than to not, which is absolutely crazy in my opinion. But let's not talk about that. Let's just talk about the pure stock buybacks. And those stock buybacks in 2018 amounted to $1.1 trillion. Companies in the United States bought back over $1 trillion of stock last year, rather than investing in growth or innovation or employee compensation. They just said, nah, we're not going to do that. Let's just buy back our stock rather than invest in the company. Keep in mind that last year, U.S. stocks, as measured by the S&P 500, were at all-time record highs and record high valuations. So companies were using their precious cash to buy back stock at all-time record high prices on all metrics. And guess who they were buying it from? Most of a large percentage of that 1.1 trillion was bought back from the corporate executives that work for those companies. So in a nutshell, corporate executives last year and even this year in 2019 are liquidating their employee stock or company stock that they own at a rate that has never been seen before in history. So ask yourself this question. If everything is so strong and wonderful in the stock market, why are corporate executives cashing out at a record speed and selling their stock back to the company that gave it to them? Very good question. And so far, we haven't even gotten 3 months into 2019 yet. And this year so far, in just the last few weeks since the 1st of January, U.S. corporations have bought back $286 billion worth of their own stock. Why do I say this? Because those stock buybacks are coming up on a blackout period because we're getting close to the earnings reports. Companies cannot buy back their stock during earnings season. They have been rushing to get those buybacks in, and that $286 billion of stock has been a driver of the stock market since Christmas. What happens when you take away that stock buyback momentum or that demand that it is providing? It leaves a void, and the last time that happened was the last quarter of 2018, and the blackout period happened after September, and we came into October, and as soon as the blackout period began, the stock market dropped 20% from basically October 1st to Christmas during the blackout period during earnings season. So a lot of people are saying keep an eye out on this market, because in the next few days the blackout period begins. And let me show you this chart here that shows how fast this blackout period will kick in. Take a look at this. Here's the chart I was just talking about. You can see that beginning on about March 25th, right here, the number of S&P 500 companies, or percentage of companies in the blackout period for stock buybacks, begins to ramp up substantially. And it looks like right here on April 1st, it goes really high. And then by about April 15th, about 80% of S&P 500 companies will be in the blackout period and unable to buy back their stock. So as this rises, that means that there will be potentially less and less demand for stock buying in the stock market, because if these companies have already bought back $286 billion in January, February, and the first part of March combined, well, what happens when that buying goes away and they have a blackout for a whole month of April, basically right here? So that is what I am hearing, is that these blackouts of stock buybacks could affect the stock market over the next 4 to 6 weeks, and it's a reason to be cautious. Before I leave this topic of corporate buybacks, I just wanted to show you this chart showing the buybacks per quarter, going back to March of 2014. And what I just wanted to show you is in the last few quarters, the quantity of corporate buybacks by S&P 500 companies is absolutely skyrocketing. You can see that the third quarter of 2018 came in at about $180 to $190 billion worth of stock buybacks right here. Then the fourth quarter of 2018, which was October, November, December, we had $250 billion worth of stock buybacks. And then just since the 1st of January 2019, we have already hit $286 billion worth of stock buybacks. So in the last 6 months already, this chart is showing that corporations have bought back $530 billion worth of stock, and that is money that they will no longer have in their treasury should they need it in the future. These companies are depleting their cash reserves in order to buy back stock to boost their stock price, and they're not going to have any emergency fund down the road if a recession occurs and they need that money to survive and thrive in the years ahead. It is concerning because if you add up all of these, we're talking trillions of dollars of stock buybacks. That is trillions of dollars that companies no longer have on their balance sheet should they need it. So that is a concern to me, and I think it should be a concern to you, because these companies, if a family should have an emergency fund, I would like to think that corporations should have one too. Okay, to wrap up this week's video, I'd like to show you the relationship between the S&P 500 stock index and the Value Line Geometric Composite stock index. And the S&P 500 is about 500 stocks, and they are weighted more heavily in the index if they are larger companies. The smaller companies are a very small fraction of the S&P 500. The Value Line Geometric Composite is a weighting, is a combination of about 1,675 individual companies, but regardless of size, they are all weighted about equally, or they are weighted equally. So it is a good broad measure of the U.S. stock market and the economy. It tells you what stocks are doing without favoring the large ones. So let's go ahead and take a look at that, because there is an extreme divergence going on that is concerning, because the Value Line Geometric Composite is not confirming this post-Christmas rally. Let's take a look. This is a one-year chart of both the S&P 500 and the Value Line Geometric Composite. The S&P 500 is this line in blue, and the Value Line Geometric Composite is in black here. You can see that for much of last year, all the way up from about March 20th, 2018, all the way up to about right here, which is about the 27th of August, 2018, the Value Line Geometric Composite and the S&P 500 pretty much walked hand in hand, and the Value Line confirmed the bullish and strong attitude that the stock market had through last spring and last summer. And then once we got to the last week of August, the S&P 500 decoupled. The Value Line Geometric Composite was the first one to show signs of weakness in this two pairs here, these two indexes. The value line started to break lower the end of August, early September, and the value line just kept going lower and lower and really took quite a beating. In fact, the high right here of the Value Line Geometric Composite was about 6.5, and it got all the way down to -20. So that means that the Value Line Geometric Composite dropped about 26% from its high in August to its low in December. That is a huge decline. And what I'm looking at, though, is not so much that, but since Christmas, the Value Line Geometric Composite is just kind of lazily hanging out down here, while the S&P 500 is all the way up here. That tells me that the broader indicator of 1,675 stocks is not confirming the amount of strength that the S&P 500 is showing right now. And if these two are supposed to be coupled together and march along the same path, it could mean that the S&P 500 could drop from up here to down here to recouple with that Value Line Geometric, and that would be about an 8% drop for this line to come down and meet this one. So that is a concern, but what is mostly concerning is that we are still below the December peak right here, the November peak, and the October peak on this Value Line Geometric Composite, meaning it doesn't have the strength to get back up to those high points, while the S&P 500 is teasing us with this breakout above the December, November, and October peak right there. So I think that the Value Line Geometric Index should be taken seriously, and some caution should be used going forward over the next few weeks, both because of the corporate stock buyback blackout and this weak Value Line Composite. Thank you again for watching this week's video. I hope you found the content very useful, and I would just say again, please use caution. We are at a very tired point in this post-Christmas rally, and I think we are due for a pullback, and we'll just see how big that pullback is, whether it's small or large. I think one is probably due. But remember what I always like to say, and that is getting back to even is not an investment strategy. Yes, the stock market always has come back from declines in the past, but the time that you spend waiting for it to come back never returns. You lose that time. And it's best to protect your investments in times of volatility and just wait for the storms to pass. And I would also remind you of my other quote, and that is, the best way to make money is not to lose it in the first place. So let's just see where we go over the next week. Thanks again for watching. I'll see you again in about another 7 days. Bye-bye.